Hello traders, this is Dan, and in this Master Trader Weekly Trade Review, I'm going to show you how we short options and credit spreads around compelling patterns and how we manage them with the charts, and in these particular examples, how we took our profits in one day to avoid risk. Keeping things really simple here, these are the only movements that stocks can make: uptrends, downtrends, sideways trends. What we're going to do is sell options around compelling patterns in all three of these time frames, and we're in essence just taking a bet that says, hey, that support is not going to be violated or that resistance won't in X number of days, and we sell options and we take in that money, which is pure profit as long as the option expires out of the money. Bull put credit spreads, so on bullish patterns we're going to make money if the stock goes up because it's getting further away from the short strike. Sideways patterns we do this in, and it can even go against us all the way down to our break-even point, and we still make money. And that's a phenomenal thing that you don't get in trading stocks directionally. A bear call credit spread, same idea, but we're shorting out of the money calls and call spreads over resistance. We make money even if it chops around, if it goes down, and it can even go up against us a little bit, similar to this one, all the way up to our break-even point. We say this gives us a cushion to be wrong, and we still make money. That's a phenomenal thing that exists in selling options. Like an insurance company, if you will, or even a casino, we're getting paid over and over and over again, taking in these small premiums. And the biggest challenge with these, obviously, is managing the losses that go against you. Our edge is doing it with the charts and taking quick profits, as I'm going to show you. So here's just another visual, a couple of what we call Master Trader bullish money patterns. Every one of these are bullish terms. Then we take these pictures, we put them in context of the overall trend, multiple time frames, what the broader market's doing, relative strength and weakness, and we decide, yep, this is a great bet to sell either naked puts or put spreads. So compelling pattern, we sell a put under support, provided the options are liquid. That's always a prerequisite, no pending news. And then we're going to buy a further out of the money put if you want it to be a put spread. And the difference of those two numbers, we're selling a higher strike, more expensive put, taking some of that money, buying a further out of the money put, and the difference is the credit that is immediately deposited into your brokerage account, and that is your potential maximum gain. And what we're doing in selling puts is we're receiving the credit, and we have an obligation to buy the underlying stock or ETF on or before expiration if the put buyer wants us to. Well, the put buyer is only going to do that if it went against us and the value of those puts went up in value. Using our chart analysis, we are making the bet of we will take that money because I think this pattern's going up, or at least sideways. So every one of these are just different Master Trader setups. We do them naked many times, but the benefit of a spread is it's less potential max loss, and also the buying power requirement at the brokerage firm is less. Let's take a look at three examples here that we did last week. Chewy here, you see all of our charts, just simple red and green candlesticks, a couple of color-coded volume, and we look at the 20, 50, and 200 period moving average. We call them visual aids, and it just speeds up the process. So Chewy here had an ugly breakdown in April. Here it's holding support. This is what we call a professional gap. It was still in a downtrend, but the 20 MA starting to flatten out, professional volume, closing breakout. This could have been an opportunity this particular day to sell a put spread, but I'm going to show you the one we did over here. Now, this had a bullish engulfing close above the 20 period moving average, two inside bars, bullish gap up. That day, you could have also sold an out of the money put spread under here, but this is the day that we did it. We had a bullish inside day, but still closing breakout again. And then we gave this to our subscribers. We said the following day, where this arrow is, over this bar's high, we're going to short the 30-25 put spread. What does that mean? This green line is the $30 short strike that we're selling. We're taking some of that money and buying a further out of the money $25 put. That's what's called a bull put credit spread. The net credit that goes into our bank account, our brokerage account, 55 cents a share. One contract represents 100 shares of the underlying. So had you sold 10 contracts of these, $550 immediately goes into your brokerage account, and you have an obligation on or before expiration, which was 8 days in this case, to buy 1,000 shares of Chewy if the put buyer wanted you to. Same day, it just rallied robustly. And so this is the format of all of our Telegram alerts to subscribers during the market. We give the date, the symbol, the strategy, technical reason, breakout of a bottoming pattern at the 50-period moving average, the green line here. And then this is the same day we entered it, 623. Close at 21 cents a share to book 62% of max gain in one day and avoid, there's actually 8 days of risk. So we made 62% of our max gain, which is $340. And we're always trying to squeeze the milk out of the coconut, if you will. Remember, we're insurance salespeople. If we can book 62% of our potential gain and eliminate a week's worth of additional gap risk, that's what we're doing, taking premiums over and over again. Fighters here had a nice short-term bottom. Our market internals told us to be on the lookout for bullish turn. So this gap right here turned out to make this a breakdown failure, bullish price action on this gap breakout. Last Friday, we suggested shorting a 7-day to expiration, Friday to Friday, 370, 360 put spread. So we picked the 370 under the week's low here. We bought a $10 wide out of the money put, took in $1.20 a share. It also rallied robustly, closing at the high here at minor resistance gap fill ahead of a long weekend. We said, let's just close it at 59 cents a share, same rationale. We made over 50% of max profit in one trading day, avoid a whole week's worth of risk, $610 on a 10 lot. Final, FedEx. We love doing this strategy on earnings stocks because the volatility, even after the earnings are announced, still remain high. There's still a lot of risk going on as people digest this through the morning session. Way back here, this is what we call a professional gap. This was a wide trading range with flat 20 and 50 period moving averages, but this was ugly. I mean, this came down here, 100% retracement, and this, we just eyeball the way we use retracements, just eyeball it. But that's like a 80-90% gap from here to here, so that's bullish. Notice the fact very little to no tail. That means despite this gapping, just eyeballing it here over $20, it still didn't retrace into the gap. So that's strength. The demand overwhelmed supply. And it closed here with a beautiful multi-month closing breakout. We did in the green trading room, we shorted naked puts that particular day. It wasn't earnings this day. There was other news that came out involving a hedge fund involvement and so forth. And then it still held this low for 1, 2, 3, 4, 5, 6 days, building support. Now I got rising 20, rising 50, and this was earnings last Friday. It took out a 5-minute high, and we shorted way out of the money 215 naked puts for the following week. And the reason I did nakeds in this case is because we found a big bid here at the 215 strike, and trying to get a good net credit was more difficult in this case because the out of the money puts were too spready. So we did the 215s naked, plus gap on earnings from bullish consolidation daily, although not shown, a bullish 1, 2, 3 continuation on the weekly chart. Always have a stop loss. Another example here. In 1 hour, folks, this was, we closed it at 47 cents. So we took 59% of our max profit in 1 hour, profiting not only on the directional move of the stock, but volatility contraction after the news is out and the stock starts moving up. We have an amazing special. So all 3 of those trades were in our weekly options trader, which specializes and only sells options and credit spreads using the master trader approach that expire 10 days or less, and that's for this rapid time decay of income. Our edge is the charts. Some option traders say, oh, sell 45-day to expiration options, and that's because they don't have an edge of technical analysis like we do. This is a superior method because you earn your money more quickly. We have a special this month of giving 33% off of an annual subscription. If you want to learn how to sell these credit spreads on your own, go to mastertrader.com/spread trader. We have 2 different depths of information of selling credit spreads using the master trader method. And of course, we also buy options as directional trades, which offers the advantages of leverage and limited risk, and also getting positive time decay, positive edge that doesn't exist in trading stocks. Hope that helps. As always, email Greg or me with any questions, and look forward to seeing you in the next trade review.